Break-even and cash flow forecasts are financial tools that help a business plan its finances by predicting when it will cover its costs and how money will move in and out over a set period. A cash flow forecast is a financial plan that estimates all expected inflows and outflows of cash to help predict the business's future liquidity. Inflows, or receipts, are the amounts of money coming into a business from various sources. The different inflows are cash sales, credit sales, loans, capital introduced, sale of assets, and bank interest received. Cash sales are inflows from customers who pay immediately for goods or services. Credit sales are inflows from customers who buy on credit and pay later. Loans are inflows from borrowed funds provided by banks or other lenders. Capital introduced is money invested into the business by its owners. Sale of assets is an inflow received when the business sells equipment, property, or other assets. Bank interest received is an inflow earned from money held in savings or other bank accounts. Outflows, or payments, are the amount of money leaving a business to pay for goods, services, and expenses. The different outflows are cash purchases, credit purchases, rent, rates, salaries, wages, utilities, purchase of assets, value-added tax, and bank interest paid. Cash purchases are outflows for goods or materials paid for immediately. Credit purchases are outflows for goods or materials bought on credit and paid for later. Rent is an outflow for the use of business premises or land. Rates are outflows paid to local authorities for business property. Salaries are outflows for paying permanent staff. Wages are outflows for paying temporary or hourly workers. Utilities are outflows for essential services such as electricity, water, and gas. Purchase of assets is an outflow used to buy equipment or property for the business. Value-added tax is an outflow paid to the government based on taxable sales. Bank interest paid is an outflow for the cost of borrowing money. Cash flow forecasts are used for planning by helping a business prepare for periods of surplus or shortage. Cash flow forecasts are used for monitoring by comparing actual cash flow against predictions to identify variances. Cash flow forecasts are used for control by allowing managers to take action when cash flow problems arise. Cash flow forecasts are used for target setting by helping a business establish financial goals and benchmarks. The benefits of cash flow forecasts are that they improve financial planning, help avoid cash shortages, and support decision-making. The limitations of cash flow forecasts are that they rely on estimates, may be affected by unexpected events, and can quickly become outdated if assumptions change. A break-even analysis is a financial tool that identifies the point where a business's total costs and total revenue are equal, meaning no profit or loss is made. Costs are the expenses a business incurs while producing and selling its goods or services. The different types of costs are variable, semi-variable, fixed, and total. Variable costs are expenses that change directly with the level of output, such as raw materials or packaging. Semi-variable costs are expenses that have both fixed and variable elements, such as telephone bills that include a basic charge plus usage fees. Fixed costs are expenses that remain the same regardless of output, such as rent or insurance. Total costs are the sum of all fixed and variable costs incurred by a business. Sales are the total income a business earns from selling its goods or services to customers. The different types of sales are total revenue, total sales, selling price per unit, and sales in value and/or units. Total revenue is the total amount of money received from sales, such as £10,000 earned from selling 500 units. Total sales are the overall number of units sold or the total value of those sales. Selling price per unit is the amount charged to customers for one product, such as £20 per unit. Sales in value and/or units represent how much revenue is generated or how many products are sold over a given period. The formula for the break-even point is fixed costs divided by contribution per unit. The area of profit and loss is calculated by comparing total revenue to total costs, where the area above the break-even point represents profit and the area below represents loss. The margin of safety is the difference between actual or projected sales and the break-even sales, showing how much sales can fall before a loss occurs. Total contribution is calculated by subtracting total variable costs from total sales revenue, while contribution per unit is calculated by subtracting variable cost per unit from selling price per unit. The benefits of contribution per unit are that it helps businesses assess product profitability and make pricing decisions, while its limitations are that it ignores fixed costs and assumes all units are sold. A break-even analysis can be used for planning by identifying the level of output needed to cover costs, for monitoring by comparing actual sales with break-even sales, for control by highlighting cost or price changes that affect profit, and for target setting by establishing clear financial goals for the business. Thank you for watching this video on break-even and cash flow forecasts. I'll see you in the next one.